Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. First and foremost, I wanted to thank all of you, the entire community here. We recently hit 2 million YouTube views over the lifetime of this channel, which I think we're going on about 4 or 5 years here now. So continuing to build this community. So thank you all for your support. But I wanted to touch this week's video on a couple comments. I'm getting a lot of questions. It's particularly interesting is from a lot of media recently. A lot of just mainstream media people reaching out to me privately, reporters asking me they're trying to understand why housing is going up. And so I'm going to get into that because I think it's an important topic that so few people understand exactly what's going on. So trying to get on that, but I do want to touch on, to sort of frame things up. I have to laugh because the most common question, the bare thesis on real estate, particularly Canadian real estate, because that's my focus. But the reality is you can apply this across any asset class. The number one comment that I always get is, "Yeah, but wait until rates rise." What people are failing to understand, I agree, don't get me wrong, it's clearly you can look at the interest rates and say these aren't sustainable. At some point they're going to have to go up. But what people are failing to understand, or maybe they're ignoring, is that global debt to GDP is at all-time highs. It's over 350% debt to GDP. In other words, the entire global financial system is insolvent. So if rates go up, everything blows up. It doesn't matter if you have over-leveraged real estate. It doesn't matter if you own stocks. It doesn't matter if you own bonds. Okay, everything blows up. Governments have failed to service their debt. Private corporations that have borrowed money, that have leveraged, taken on debt to, say, borrow back stock, they start to come under pressure. They have to start looking at cutting. They'll start cutting jobs, etc. And it's the same thing for over-levered households, which all of you here in Canada are very familiar with. If rates go up, a lot of people will go delinquent on their mortgages. They'll have problems refinancing. And it's this cascading thing of the knock-on effects. The knock-on effects of when rates go up, house prices go down. When house prices go down, people start pinching their wallet a little more and they don't spend. So basically the entire global financial system is predicated on essentially rates continuing to go lower, or essentially being able to continue to grow the debt. And the only way you're able to do that basically is by continuing to grow credit. And that obviously becomes a very interesting dilemma in an era where you've already hit the lower bound of 0% interest rates. And so this is something that I think really just understanding now what policymakers now have to do, how they're going to try to they basically pin themselves into the corner. That's just the way our financial system is. It's the way it was created, that they now are tough with very difficult decisions. And I think no better person to frame this up is Russell Napier in a recent interview with Real Vision. I would highly encourage you to subscribe and watch the full-length interview. But I think Russell really dials in and articulates better than I ever could. So let's clip to that interview right now.
Yeah, I'll try and get it into a very short period of time so we can get on to discussing what it means for investment. But the simple way to explain this is that there have always been two ways of creating money. One is by a central bank, but most importantly, the other is by commercial banks. And the vast majority of all the money in the world is being created by commercial banks. Now, sometimes that astounds people. But of course, the idea is that the central banks kind of control the commercial banks, and therefore they are in control at the rate at which the commercial banks create money. My entire thesis is that changed in May. It changed April, May, and it changed through the use of what we call government bank guarantee schemes, or bank credit guarantee schemes. And it sounds like a very technocratic, not very interesting, not very important shift, but actually it's fundamental. And last week, the European Central Bank recognized this, and they call it the sovereign bank corporate nexus, which is a classic piece, a euphemism for the fact that money is now created by governments, not by central banks. Now, I can't persuade anybody of that, even though the ECB has now come out and said it as well. Because once a government is in offering that guarantee to the bank begins to lend money. And we've seen spectacular growth in bank credit in this biggest recession in this country being the United Kingdom, since 1708. Fastest bank credit growth probably we've ever seen, or certainly one of the highest we've ever seen in peacetime. How on earth do you reconcile those? The government guarantees it. So when those bank loans are made, money is created. And that has been the failure of central banking now for 12 years, that they absolutely failed to do that. They created a lot of their type of money, which is technically called a bank reserve and sits in the banking system. But they didn't create a lot of what I call our type of money. And by what I mean our type of money, I mean citizens, people who spend it, the stuff that we pick up in GDP and measure in GDP. And my goodness, the governments are doing a spectacular job at creating that. So to give you some numbers, the growth in the total number of dollars in the world is up 25% year on year. For the yen, we're looking about 9% year on year. For the euro even, we're getting to 10% year on year. And these numbers, these growth rates have all doubled or tripled during COVID-19. So the first point is that it's a new mechanism. It is working. Historically, that level of money supply growth would normally create inflation. And there's a bit of people doubt that. But at that very high level, it's almost certainly the case. And then the second part, Steve, which we will no doubt talk a great deal about, is that leads us to a time when bond yields are capped, when the state central bank regulator does not allow the bond yields to reflect the inflation outlook. And that is something called financial repression. And it leads us down a rabbit hole for a generation of government control mechanisms to try and force savers to own an asset they don't want to own. And if I started to talk about that in detail, it would take me 90 minutes. But that is the outline of two things. One, inflation's coming because the control of money is coming. But it takes us to a world where we have to control the yield curve. And that takes us to a thing called financial repression. And then we're definitely not in Kansas anymore.
So again, this is something that I've talked about numerous times, and something that Russell Napier here is eloquently suggesting, is that essentially that we have to continue to create new credit. The majority of credit is created through commercial banks. Okay, commercial banks create over 95% of actual credit. And remember, credit is money in a credit-based financial monetary system. And so you're in this scenario where we had this downturn, and so what do the governments, what do? They basically join forces with central banks and says, we need to get the banks to continue to lend. And the easiest way for banks to continue to lend and to continue to create new credit, because if you don't have credit growth, you will have a downturn. You will have basically a depression. So you need to keep the spigots open. And obviously when people are losing their jobs, and there's weakness in the overall economy because people are locked in their homes, there isn't a whole lot of demand for credit. So we need to stoke demand. So basically the banks aggressively start issuing new mortgages. And that's what we did in Canada. So when I get these calls from these reporters, again, a lot of the mainstream media that don't necessarily understand or focus on finance or on global macroeconomics, I have to sort of explain this to them. So I say, this is what happened in Canada. You had a downturn that everybody was panicking in April, and everybody was basically worried that we're going to enter Great Depression 2.0. So what do? Okay, well, we need to open the spigots. We need to create credit. So the central banks intervene. They start intervening in financial markets, buying up government debt, suppressing the yields. Agencies like CMHC and the Bank of Canada again come in. OSFI comes in, lowers the bank's reserve requirements. So they say, you know what, you keep lending. You push money out the door. And so what we can see here now is they opted to create a housing boom. They opted to create a credit boom in housing in order to stave off a downturn in prices and actually support the house prices, and that's why they're up. So for example, look at residential mortgage credit growth compared to non-mortgage credit growth. Over the past year, you now have residential mortgage credit growth growing again at decade highs in comparison to other forms of credit. So basically what this is banks have directed the vast majority, the bulk of new credit creation that banks basically create at the touch of a keystroke, They created credit by issuing new mortgages. This basically increases the money supply. This, if you're thinking of one way to stave off a housing downturn, like obviously people were scared about a housing bubble in Canada pre-pandemic. And so you can imagine what would happen if all of a sudden the credit valves shut off. You'd have this massive collapse in housing prices. And so what did they do? They said, okay, listen, we're got all these people that wanted to defer their mortgages. At one point, I think it was 17% of all mortgages in Canada were in deferral. So we've got all these people that are in deferral. Oh my gosh, what are we going to do? If we stop lending because we're scared, house prices will fall even further, and so will the economy. And it basically is a self-fulfilling feedback loop. So what do? Okay, let's open up the spigots. Let's just start hammering out mortgages. Anyone, you want a mortgage, you got a mortgage. You want to refinance it, we refinance you, no problem. Here you go. Hammer rates down, 5-year fix, 1.5%. Get credit out the door. And so what that actually does is now they've actually increased. How do you stave off? Housing insolvency, for example? So someone that is going to go delinquent on their mortgage, so they're in mortgage deferral. Well, what's one way to prevent that house from going into foreclosure? It's by raising the prices of all the houses around them. So this person might be distressed and say, I can't pay my mortgage. But hey, lo and behold, house market's up. It's completely liquid. We got multiple offers everywhere. Houses are flying off the shelves. I can't pay my mortgage. I've just lost my job, but I'll just put my house in the market. I can sell it in a week, and I'll probably make a whole ton of money because the market's up. And so this almost basically papers over this whole it basically papers over all these deadbeat borrowers that otherwise should be delinquent. They maybe over leveraged themselves. They took on too much debt, and they probably should be going in through a bank foreclosure. But lo and behold, we pumped the system full of credit. The rising tide lifted all boats. And so this guy's bad mortgage now looks like a good mortgage because the market went up, he sold, he paid off his debt, and he's moving on with his life. And so this is what the banks did, is again, they opted to create money because they are the creators of credit. They opted to create money, and they opted to create that money by issuing new residential mortgages. And this is basically what has created the rising house prices. Because again, I'm getting these reporters calling me and saying, I don't get it. Like, there's no immigration. There's very little population growth. The labor market, the economy is not that great. Why are house prices going up? Why are we hitting double-digit house price growth? Why are we seeing record home sales? I don't understand. And so it obviously becomes very difficult now for me to then explain to them how banks create credit and how they basically opted. It almost sounds again like this grand conspiracy theory, but this is what it is. And so they're asking me, well, what should policymakers do? Like, housing is becoming so unaffordable. And the answer is quite simple, really. It is an answer, unfortunately, where I don't believe policymakers will actually go. But this is something that Professor Richard Werner has talked about extensively. He's basically the first pioneer of how credit and money is actually created through commercial banks. Is that you basically have to mandate to the banks you basically mandate to the banks where they're allowed to allocate credit. So you go to as the regulator, as the government. You go to the banks and you say, listen, you're only allowed to allocate X amount of, you're only allowed to create X amount of residential mortgages per year. You're capped at 5% growth per year in residential mortgages. If you want to allocate more credit, you need to do that into small and medium-sized businesses. You need to go issue business loans. And so that would create the scenario where you start creating obviously more productivity. So you get the banks creating credit not into residential real estate, which is ultimately an unproductive asset. It doesn't actually generate or create anything of value. When the house prices go up, it's not necessarily creating value like starting a new business does. Starting a new business, creates new employees. It creates innovation. So you force the banks to basically, it's called creating basically window guidance. You tell them where they can allocate that credit, and that gets them away from lending all this new credit and creating all this money into residential real estate and pushing the prices way up where nobody can ultimately afford them. However, I don't really think policymakers are going to go there, at least not anytime soon. But it's going to reach a point now where the social friction becomes so large, the revolt, particularly among these millennials that are priced out of housing, possibly indefinitely, is that the pitchforks will come out, and the regulators, in my opinion, will be forced to. They'll be forced to basically start incentivizing first-time home buyers. So, for example, they could say, okay, if you're a first-time home buyer, we'll give you a 40-year amortization. You only have to you can put zero down if you're a first-time home buyer. And by the way, for all the investors, if you already own 2 homes, if you want a third home, you have to put down minimum 35% down payment. And you can only amortize that to a maximum of, say, 20 or 25 years. So you want to basically reduce the amount of credit going to the investors and incentivize the people that have basically been priced out through the previous policies. Again, I think this is probably a little bit of ways off. It could be a year, it could be 5 years, but at some point, I think everybody's well aware that this is an unsustainable trajectory that we're on. But this is This is the route that policymakers opted to go, and left unchecked. If banks are left unchecked to create credit, the creators of credit, they will be a gross misallocation. I think that is what we have here today, and the numbers and the data is very, very simple. So to basically sort of summarize my thoughts is real interest rates cannot be allowed to rise sustainably. They might, as we're seeing right now in yields. Globally, yields are shooting up. People are fearful of inflation. At some point, I think maybe another 100 basis points, central banks are going to have to intervene. I think that, similar to Russell Napier is saying, is they'll have to intervene through not necessarily central banks expanding their balance sheet, because look at the Bank of Canada, they're going to hit 50% of their mandated holdings as of next year. So they're going to have to go back to these banks and these savings institutions and say, hey, listen, anytime the Canada 5-year bond hits, 1%, you got to buy. You are mandated to buy. As long as that 5-year starts tipping over 1%, you must buy. As opposed to the central banks simply expanding their balance sheet. So that's number one. And number two is, I think that at some point, if people want to get serious about housing affordability and productivity in Canada, we'll have to look at some form of window guidance. And I think that these policy measures, again, whether you like them, don't shoot the messenger. I feel that they are probably inevitable, but they could be much further away than anybody expects them to be. So I hope this video brought you some value, some entertainment. I understand it is a very complex topic, but once you can really understand once you can understand the financial system and how banks work and how they actually create credit, it'll kind of help you understand the world in a different picture. And so, you can imagine a world, I feel so bad because I get so many DMs from just, your average day-to-day person saying, oh, I'm working hard, I'm saving my money, and I just feel like I'm getting further and further behind. I can't even afford a condo, blah, 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 blah. And unfortunately, savers in an era of negative interest rates and double-digit money supply growth, savers are losers, and they are going to continue to lose, I think, in this environment, because we're forced to keep real interest rates have to be negative until you can slowly erode and inflate that debt away. So we'll see you next week.